Good morning again, everyone, and a very warm welcome to the first webinar that we're going to be holding today under the webinar series that is about advancing hydrogen valleys to final investment decision. Today, we're going to be dealing with the topic of offtake, both from a market perspective, what are offtake trends, things that we observe in the market, recent developments, but also for more from a, let's say, functional and how to do it perspective, how to go about securing offtake in the market environment that we see today, and what the concrete steps are that hydrogen valleys and hydrogen project developers more broadly can take in practical terms. In terms of agenda, so what to expect today, we have about 1.5 hours total. We'll start with a brief opening and welcome, then have a little less than an hour of content presentation, where we would also like to involve you with some interactive poll elements to make it a little bit more interactive and activating on your end. And then we'll have about 25 minutes in the end reserved for Q&A, where you're going to be able to raise questions and we can have an open discussion around the topics and also take on board your feedback regarding the things presented. So that's the plan in a nutshell. Before we start, maybe a few words on the rules of the game, so to speak, given that we have a rather large number of attendees. We need to have a few rules in place. So during the presentation, your microphones and your cameras will be deactivated. We will activate the live polls in MS Teams, so all of you can participate at different instances in the presentation. And then once we're done with the presentation part and we enter into the Q&A part, we will activate all of your microphones, and you will have the option to also have the camera activated. And then we would like to ask you to raise your virtual hands or digital hands to indicate that you want to ask a question, and then we take them one by one. Or alternatively, you can also type them into the chat and we'll try to keep an overview. Okay, that's it in terms of setup. And then I suggest we start with the introduction of whom you're actually seeing on the call. And we're very happy that we have Mirela and Antonio with us from the Clean Hydrogen Partnership, who are working closely with us, another H2B facility, and who are the hosts, so to speak, of this event today. Mirela will also deliver a few opening remarks in a minute, but maybe Mirela and Antonio, over to you for a brief intro.
Thank you very much. Do I also go to the remarks or just introduce myself, Christopher?
Please get started straight away with the remarks.
Okay, thank you. Thank you very much, Christopher, for the kind introduction. And would like to also welcome on my side all of you to indeed the first webinar of a series of several that our Hydrogen Valley facility will provide to help all the projects, like Christopher nicely put, but in particular the Hydrogen Valley projects to proceed to final investment decision. What it is, in fact, the Hydrogen Valley facility that will facilitate to you the webinar today, but also, like I said, more during the course of the year. It's a facility that we put in place last year in 2025. And we hope to offer support with it, many types of support, and I'm sure Christopher and the team in Rollenberger will explain it. Support in many ways, not only with webinars and with teaching material or support material, but also support by bringing the community together. And I think this is also one of the scopes of this webinar. But now the facility, the Hydrogen Valley facility, didn't come out of the blue. It came because for more than 18 years in a partnership here in Brussels, we work and we support not only the public member, the European Commission, but also the industry and the research community through the two associations, our members, Hydrogen Europe and Hydrogen Europe Research, to develop the technology, the hydrogen technology, to bring it into the market, to test it, to learn, and then further on with Vale's projects such the ones we will talk today. We hope to accelerate the implementation of the hydrogen economy. So in that respect, like I said, for many, many years, we brought this technology. We showed that it worked. We had Europe deciding in 2020 to even build a hydrogen strategy. We have the Green Deal, and now lately we are, as this technology becomes important strategically or geopolitically for Europe, we now start looking into competitiveness matters. And I have to say here, we do not only help Europe to stay an industrial leader, but we also help keeping the industry in general competitive through innovation. In doing that, like I said, and in particular, when we talk about innovation at ecosystem levels, this is where we come to the hydrogen valleys. And this is a concept that Europe is proud, and the joint undertaking, the partnership is proud to put in place together with the colleagues in Rollenberger as of 2016. I have to say, for more than 10 years, we have worked on this innovative ideas, innovative approaches, if you want, at local level, where we bring not only the industry together with the public authorities, with the public side, with the public funding, but also with the research community, and why not with the local actors, with the regions, with public authorities. And now more and more, we also get the project developers, because the projects start to become interesting, commercially speaking. Last words from me is just to say that in addition to this facility and all the work that the colleagues in Rollenberger are helping us with, we also have a dedicated stream of grants. We support with grants projects to progress, in particular CAPEX in the grants. And we try to put first of a kind such projects across Europe. And so far, we supported 27 hydrogen valleys across Europe for more than 300 million, 1.6 billion total cost. And with the help of colleagues in Rollenberger, and you will hear probably from them today about that, we also have another stream of project development assistance, where we help the projects to go through the pre-feasibility, feasibility stage with a roadmap to the final investment decision. So without saying too much, but trying to tell you why we're here today, what the partnership in Europe has done, the speed that has brought in the last 18 years, in particular the last 10 working at local level on this hydrogen valleys concept, helping Europe to stay a leader, and hoping also that we will continue that in the next 10 to 15 years. I really look forward to the discussions today. I'm sure it's going to be interesting for all of us. And I just want to finish by thanking first the Rollenberger team, Marcus, Christopher, Christian here already with us. But last but not least, I would like to thank my team leader, Antonio Aguilo, who's supporting and leading this activity in the partnership, and of course supported by the colleagues Pietro, Renata. Already I saw them attending. So with that, I would like to like I said, thank you very much, and I look forward to the discussion. Antonio, would you like to say something to add?
No, just to welcome everyone. Thank you for the words, Mirela, and thanks to the team in Rollenberger. So yeah, wish you a good event and a good webinar. First of many to come. Thank you.
Very good. Thank you, Mirela, for your kind introductory words. And yeah, maybe continuing with the introduction very briefly so that we can jump into the content. On the Rollenberger side, my name is Christopher Schmidt. I'm a partner at RB, and I have the pleasure of co-leading jointly with my partner colleague, Marcus, who's also in the call today and who's also going to deliver part of the presentation, the overall Hydrogen Valleys facility that Mirela has so nicely outlined in her statement. And with us today is also Christian Geiger, the project manager, who is leading the assignment on an operational level on our side, and who's also going to be presenting today. So without further ado, I suggest we jump straight into the next slides. Mirela has already outlined the overall architecture of the facility. No need to go through this in detail. The only message I want to bring across is there's a lot of offerings, there's a lot of opportunities for hydrogen valleys and developers out there. Please check it out. h2v.eu is the single point of contact where you can find all of the information, hopefully many resources that might prove useful to you. And what's important is that this webinar today is not meant to be a one-off, but it's meant to be part of a series, the first in a series, in fact. So there's an overarching program, curriculum, if you want, that is all centered around the motive of advancing hydrogen projects and hydrogen valleys to final investment decision. The first one, again, today about offtake. The second and third one for the remainder of the year have already been scheduled, looking into the steps to bring valleys to FID, and looking specifically for the third one into regulatory topics around RFNBO and low carbon hydrogen. So please earmark those in your respective agendas, and we'd be very happy to welcome you also for the next webinars. And again, all of that can be found on h2v.eu if this was too fast, and you can also register there already and download the calendar invite so you have it already ahead of time. Very good. Before we start, of course, it's also interesting for us to learn a bit about who it is that dialed in and what kind of a spread we have across different types of players in the hydrogen ecosystem. So we'd like you to take a minute to basically place yourself and choose here in the window that just popped up which of the following groups best describes you: hydrogen producer, transport operator, off-taker, technology manufacturer or OEM, local or regional authority, regulator, financial investor, or are you rather from the academia and research space? All right, very good. I think we have responses from more than half of the participants, and I think a really nice spread across the different steps of the value chain and the different roles that play an important role in the overall H2 Valley ecosystem. Quite a heavy focus on the upstream side, H2 production, but also the other steps of the value chain represented to a reasonable extent, and also a lot of colleagues from academia and research on the call. So good to see that we have a nice coverage and a nice spread along the value chain. So thanks for that. And then I suggest we jump right into the first chapter, which talks about the general market environment in which offtake takes place today. Over to you, Marcus.
Yeah, very glad to hear and good to see that in a webinar around offtake, there's a lot of aspiring or active hydrogen producers. So that makes total sense. Thanks for joining. Hope to be able to tell you a little bit of how we see the clean hydrogen market, the green hydrogen market in particular, evolving in Europe, and what that means for shaping viable offtake strategies. Before we go into the content, we like to start with a little open poll quickly. That's already popped up on your screen. What is really driving the hydrogen market at the moment? What do you think is the single strongest driver of the hydrogen market in 2026? So please submit your answer. And we're going to see basically based on the number of responses and sort of intelligent grouping and bundling of different keywords, what and then by the size of them, what the collective opinion is. Yeah, as the responses are shaping up, there's a big fat word in the middle. It's regulation. And then there's a couple of other keywords, quota obligations, RED 3 regulation and policy, RFNBO regulation and subsidies. That is clearly in the same cloud of topics, which is indeed, wherever we see in the market strong progressive regulation for the adoption of clean hydrogen, we see real demand, we see real offtake commitments, and we see projects, right? And that's probably a bit unsurprisingly for most of the audience, going to be a bit the theme of this presentation and how to work with that, how to get there. There's a couple of other things I want to highlight, which I think are extremely apt as well. One is, grid constraints is an interesting one, which, it's a driver, yes, yeah. Whichever project developer that is not sitting or is developing his own dedicated renewables has access to the power grid and can thus, conclude PPAs, has a big advantage over others who are struggling to get such grid access. So indeed, that's another one. Cost of electricity, fuel cost, of course, as well. Yeah, but I think the regulation theme is clearly dominant. Okay, so let's take that along, because I think that's a nice transition and a little bit of a sort of recurring theme, as you will see, that will carry us through the presentation. I'm going to start with a general overview of the market. Then Christian is going to look a bit more closely into willingness to pay and who's willing to pay how much for how much of hydrogen. And then we're going to try to operationalize that towards what an offtake strategy nowadays could look like. So for the last 6 years, I've been starting presentations like this, typically with the message that in the long run, the sky's the limit for clean hydrogen. To reach net zero, there's pretty much universal consensus that a massive amount of clean hydrogen will be needed. The vast majority of that will be green hydrogen. So, the IEA as of last year says in a world that is net zero by 2050, we'd have to have around 380 million tons of hydrogen consumed every year, of which 80% needs to be green, the rest blue, and that would require almost 3 terawatts of electrolyzers installed in the world. End of last year, we were around 3 in the world, so there's a long way to go. We're going to look at the currently installed base in a second as we see them. The current policy scenario is much less aggressive than that, even though that is also quite ambitious. Needless to say, the step scenario is a little bit in between, but really the key is there's going to be no such thing as net zero without a lot of green hydrogen. And that, as long as climate policy, at least in Europe, and basically decarbonization policy remains focused on that goal and remains progressive in this sense, there's going to be a long-term strong policy environment for green hydrogen and that and accordingly for electrolyzer and green hydrogen projects. On the next slide, we want to dive a little deeper into what that has triggered actually this clearly sort of this clear ambition and clear goal to stay within the net zero targets around the world, which is really in the last in this decade an unprecedented development of a global, very big and very diverse landscape of electrolyzer projects, of green hydrogen projects. We count today, together with the other public sources like the IEA, around 440 gigawatts of announcements, which aim to be announced projects would aim to be realized by 2030. We don't think nearly all of them will actually be realized, primarily because of the offtake constraints that we see, of the firm demand constraints that we see. But needless to say, there's a very vibrant project developer landscape. The most vibrant of all is in Europe, as you can see, with the most projects, which are on average, of course, smaller than in the global south, but which also cater to different use cases and applications, with lots of mobility-focused projects and lots of on-site industrial electrolyzers, where you have them co-located to refineries, green steel plants, etc. So here also Europe clearly leading the world, and is Europe we consider the most vibrant and the most sort of sustainably leading green hydrogen market in the world, next to China. On the next slide, what have we observed in the last years, and what we have seen in the sort of real life experience of actually making projects happen? Yeah, of course, the entire sector has gone through a bit of a cycle. Yeah, I think that's an open secret. This might be a visual one or two of you have seen on LinkedIn and somewhere else, and we want to be very transparent with how Roland Berger has looked at the world of electrolyzers and the market outlook in recent years. So as at the peak of the hype cycle of this current business cycle, we estimated that we could see 120 gigawatts of electrolyzers installed in the year 2030. Yeah, that was our most positive outlook. We currently assess and think that about 40 gigawatts, so that would be roughly 10% of all the projects that have been announced, will actually be implemented and be operational as of the end of the year of 2030. Yeah, which is still, from where we are today and where we were at the beginning of the decade, a massive growth story. The growth story is comparable to that of renewables, for instance, PV, in their first decade of real deployment. But it's of course a bit below the initial expectations, which were even higher. Yeah. So the real question is now, what separates an announcement from a real project, and sort of what's behind the question and the answer ultimately, which projects can take FID because they have secured firm offtake and can thus progress and actually be implemented. And that's what we want to look at in the next couple minutes. Yeah. The key thing that we need to assess basically before we look at the demand side and willingness to pay, that Christian will talk about in a second, is that in addition to the fact that sort of overall projects were and project announcements have been more ambitious, we also see that the real cost in the market are higher than originally anticipated. Yeah, so what we have done here is a little bit of a post-mortem analysis of the originally announced levelized cost of hydrogen in the years of 22, 23, as the market was really still on the rise. Lots of projects were developing. There was lots of very aggressive targets announced of how far down electrolyzer capex could come down, how quickly, and all of that. And then what we have actually seen here, we've taken the last year's European Hydrogen Bank auction as a proxy, and you see, of course, that the delta is quite large. Yeah, so and this is production cost. Yeah, if we actually observe now delivered cost at the off-taker side, we typically see, especially in in Northern and Central Europe, price points which are double-digit, so 10 euros a kilogram and more. And that, of course, means that you have to have off-takers with sufficiently high willingness to pay to make a business case and come together, landed cost and willingness to pay, and actually have conclude an offtake agreement and be able to realize a project. Why? Because all projects that are being implemented today, or virtually all of them, are captive in the sense that they need a dedicated offtaker, a long-term offtake commitment. There is no liquid market for green hydrogen or green molecules yet, if projects do require, as said, the dedicated offtake commitment. Yeah. Needless to say, on the next slide, we have seen lots of projects under implementation, and we have even more that's sort of in the pipeline. And here, what we're doing is a bit of a zoom in of the landscape that we see in Europe. We estimate that there is around 600 megawatts of operational electrolyzer capacity today. Most of that has been, and the capacity that's commissioned has been steadily on the rise, with 200 megawatts commissioned last year. Year to date, only 30 megawatts this year, but we expect more projects to come online over the remainder of the year in the second half of 2026. Quite a widespread of use cases. Historically speaking, also a lot of electrolyzers serving sort of non-industrial or refining use cases, especially in mobility. That's a large chunk of other you see there. And when we look at the stuff that's under construction, the post-FID projects, you really see that the market is changing from what it used to be. The vast majority of projects that are currently under construction have taken a final investment decision, aim to supply hydrogen to refineries. So there's more than a dozen projects of 100 megawatt and more in Europe in active implementation, serving refineries, to either, or in most cases, co-located to the off-taker. In other cases, supplying the target refinery by pipeline that is under construction or under implementation. Steel is next, so those are the big projects in Sweden and in Germany, predominantly serving the first of their kind green steel plants. And so you see here already where the regulatory case, where the policy case is strong enough, as it's the case, as you will see in refining with high enough willingness to pay, thanks to RED III mainly, or in steel, where the thanks to the grant agreements that the steel plant developers signed with the national governments, hydrogen consumption is sort of mandated to a certain extent. That triggers real investment decision, that triggers real projects that go under construction, as we see now. And we currently have around another 4 gigs in Europe under construction. We think the total installed base in Europe could reach 12 to 13 gigawatts in total by the end of the decade. Now, looking lastly, before we turn to the offtake side in a more narrow sense, at the hydrogen valleys that we work with in the facility and on the platform. We have taken the sample of all the European valleys that we feature now on h2v.eu. That's 82 projects in total, or if they were all built to the full extent, around about 8 gigawatts. We see a strong level of progression already, with a total of 35% of projects roughly post-FID, and 12% more already in FEED, so spending real DevEx, sometimes tens of millions on engineering studies to advance the project, accelerate permitting, start procurement, etc., and so forth. So, and most of these, and a lot of these valleys are also, let's say, centered, and that's what they have in common, around very strong off-takers, industrial off-takers in particular, again, driven by regulation, high enough willingness to pay and demand, and that allow them basically to, with that anchor off-take, to implement and move forward the valley as a whole. So much for the introductory remarks. So lots of long-term strong potential that we still see for the market. Lots of projects. Real projects will depend on firm offtake with high enough willingness to pay, especially as costs are higher than originally anticipated, and we do not expect costs to magically fall in orders of magnitude in the next years. No, but where we do see a strong momentum, especially in Europe, especially thanks to the hydrogen valleys around those offtake groups that have that high enough willingness to pay, that firm demand, thanks to progressive regulation. And that's what Christian is going to dive into now in the next chapter.
Well, thank you very much, Markus. Exactly. But before we go into our contents and on our view on willingness to pay and really key end-use segments going forward, we would like to get your view and your opinion on the most promising end-use segments where you expect the strongest demand for green H2 over the course of the next years. So you now should see the poll being live, and for you to sort of like prioritize the end-use segments. So let's take a minute to get your answers. So we can already see clear trend towards industry use cases, so refining, steel being up there, followed by chemicals, then some mobility use cases, namely shipping, aviation, road mobility, sort of like the energy use cases at the bottom with power generation and process heat. Well, steel and refining appears to be a close race. Now, thanks for your answers. So again, it's a clear trend that industrial use cases at this point appear to be also for you the most promising end-use segments, and we'd like to give you now our view based on our analysis, what we believe will be the strongest end-use segments, really driving up the demand for green H2 going forward. Now, we've learned in the beginning that also a clear trend from you, from this audience, as to what's driving the green H2 sector right now and going forward is the regulation, and that perfectly resonates with our analysis and understanding of the market. So if we talk about willingness to pay, if we talk about demand forecasts, we cannot omit and skip a discussion around regulation. So maybe as a brief overview of sort of like the three pillars of regulation we see really shaping the demand and willingness to pay in the market. So the first pillar is a more general CO2 pricing under the EU ETS scheme. Well, obviously, this one really targets at sort of like fossil deployment of fossil energy solutions being more expensive, making alternative decarbonized pathways more competitive. However, this is not really promoting the H2 solution specifically, but more generally speaking, any other decarbonization pathway, which is in competition with sort of like the fossil pathway in a sense. Then secondly, we have regulations really centered around green H2 specific quotas, most notably, obviously, the RED III. And this one is really spanning, if we look at the end-use segments here on the left-hand side of the slide, really focusing around industrial and mobility use cases as it stands. So here we have a very strong driver, regulatory driver, really targeted at the uptake and promoting the competitiveness of green H2 in the market. Then lastly, but also worth noting, we have some end-use specific regulations listed here, really focused on the mobility as use cases, most notably the FuelEU Maritime, focused on shipping, along with the RefuelEU Aviation, focused on the deployment of eSAF with binding quotas, which are increasingly gradually over the next 10 to 15 years. Now, considering the regulations and so the regulatory pathway going forward until 2035, we have prepared our forecast, which is based on these regulations and the corresponding quotas. And here we're looking at sort of like the hydrogen demand overall in Europe, split by the color of production pathway, if you will. So what becomes evident here is we do expect overall a strong increase in hydrogen demand overall, from around 8 million tons per year in 25 to 40 million tons a year in 2035, so in 10 years. So what's driving the demand? What's driving not the demand, but really, so how is the composition of the H2 production spread going forward? So a key driver of these volumes are expected to be in RFNBO H2 and low carbon H2 of non-fossil origin. It's a special animal, if you will. So that's really driven by the regulation under the RefuelEU, which features low carbon H2 of non-fossil origin next to RFNBO H2, but also the blue H2, so SMR with CCU. As for the gray hydrogen part, which constitutes roughly 7.6 million tons as of today, we do expect this volumes to decrease gradually down to 5.4 million tons in 2035. So we can actually see an increase in the volumes driven by new green H2 volumes, but also a substitution of today's gray volumes with low carbon H2 volumes. Now, looking at sort of like the demand side of things, so what is really driving the demand in the sector? First of all, as of today, we can see that most of the demand comes from the industrial use cases, namely refining, but also ammonia, methanol for the chemical industry. And what we expect the demand drivers or the end-use segments to be, which are really driving up the demand, most notably the mobility end-use segments, namely aviation, road mobility, and shipping, along with some energy use cases, namely heat and power generation. So these are the end-use segments we expect to be a strong driver for low carbon and green H2 going forward. And as for the industrial use cases, still we believe refining will be the main driver for hydrogen demand going forward. And here we do expect some substitution from gray volumes with low carbon and green volumes. Now, looking at willingness to pay analysis, we have prepared also based on the regulatory frameworks. As we laid out earlier, we do see some H2 specific regulations along with some decarbonization regulation, namely the CO2 pricing under EU ETS. And what we found is the demand, the end-use segments being targeted by H2 specific regulations, namely refining, shipping, and aviation, show the highest willingness to pay going forward, right? And here, sort of the light purple shape indicates the real-world hydrogen production cost corridor in Europe, derived from a European Hydrogen Bank auction. So, as you can see, the production cost corridor really meets the willingness to pay for these specific end-use segments, and these are actually the segments where we believe a real cost competitiveness is being created. So these end-use segments really have a sufficient willingness to pay to actually meet the production cost in Europe. Well, down the chart on the x-axis, you can see several additional end-use segments and corresponding volumes, which are driven by the decarbonization regulations, so CO2 pricing, and you can clearly see that there's a sharp decline in willingness to pay here. So we do not expect competitive or sufficient willingness to pay purely driven by CO2 prices going forward. So there's still a gap between the willingness to pay here for the decarbonization regulation and the production cost in Europe. Maybe a few insights into what we see in the market. Firstly, looking at sort of like the historic.
Christian, sorry, I didn't unmute myself quick enough. Can you go back quickly? I think this is probably one of the most important slides in this presentation. If I may say that. So this is the basically the attempt to a demand curve, right? A merit order for hydrogen prospective hydrogen off-takers. A lot of you will have seen similar slides before, and it's a bit schematic, of course, because you can break down those pockets even further into different location, into different regional circumstances, etc. Especially when it comes to sort of next best alternative comparisons. But what I do want to say is, here we took the example of Germany, which, as said, has a particularly high penalty on the red 3 quotas. But the general merit order, the general kind of pecking order of the offtake sectors is the same across all EU member states. As you know, it's in an essence shaped by European regulation, that regulation that is hydrogen specific, and by the ETS, which is a European-wide carbon pricing mechanism. So that's important. So regardless of whether you want to sell to someone in Germany or somewhere else, you're going to, for the highest willingness to pay prospective off-takers, you're going to be looking to the left of this slide with those segments that we have depicted here. Sorry, Christian. Moving on.
Of course. We're happy to take any questions on this at the end of this presentation of this webinar. Now, moving on, a few insights into the market and recent dynamics in sort of like H2 offtake globally. Firstly, location-wise, we can see on the supplier side as well as on the offtake side, Europe is sort of the dominant geography. That's mainly driven by some fierce regulation and strong regulation, which we see in Europe compared to other geographies. Similarly, we can see that the share for the offtake allocation for Europe is higher than the supply allocation, which sort of like reflects the status as a net importer of hydrogen of Europe, globally speaking. When we look at the offtake sectors, so also historically kind of resonates with our assessment, which reflects obviously willingness to pay going forward, but we see a strong share of offtake agreements being made in the chemicals industry, refining, steel, but also shipping and energy use cases and energy use case. We'll come to that in a minute. This also is being reflected by the end product type. So a strong share of ammonia for the chemical industry, methanol fuel being used also for shipping, obviously, and hydrogen, obviously a large share for refining and steel use cases. Now, looking at sort of like the volumes of offtake agreements being signed over the years, we do see a clear trend. So there was a peak in 23, and we looked at the sort of like market sentiment curve before. So obviously, as we all know, there was a huge hype and market momentum for hydrogen in 23, which slightly decreased over the course of the last 2 years. And this is also being reflected here in the numbers. So strong peak in offtake agreements in 23, and then 24 it went down a bit. And in 25, we actually saw sort of like a stable volume of offtake agreements compared to 24. But it's worth noting that this is strongly driven by Japan, actually. So under the contracts for difference for the H2, green ammonia based on H2 factor. So green ammonia being used for the coal-firing and coal-fire plants. That really pushed the market and offtake agreements in 25. This is really dominated by 2 major offtake agreements coming out of Japan. This really constitutes this large share here for energy uses, which you can see in the bar chart for 2025. What's also worth noting is if we look at the light purple dot here in the chart, so that represents the share of firm agreements out of the offtake agreements, which are depicted here. So what first comes to the eye is in 22 we saw a strong uptake in the share of firm offtake agreements compared to 21. So this is sort of like explained by the fact that 22 we really saw some first large projects reaching FID, which obviously also requires firm offtakes to be in place. And over the course of the last few years, we saw this number and this share to be fairly level, so around 20 to 25% over the years. Now, a few quick look in the market, some recent offtake agreements which we saw in the market, spanning industry and also energy use cases. First of all, refining, some recent offtake agreement from last year for the Leuna refinery in Germany. Then secondly, energy use case, which I just mentioned, the Japanese case, which was for 1.4 million tons, really driving so like the statistics and offtake agreements which we just looked at from JERA as the offtaker, and then also steel, so Indian player here with like a large scale offtake agreements for 800,000 tons, and lastly also the chemical sector, Uniper signed with an Indian supplier this year. Now, a quick view on sort of the H2 Valley statistics. So for the values which we have on the platform, here we are looking at a survey which we conducted regarding what share of their envisaged production volume they now have secured offtake for, and we can see that well, 70%, almost 70% of the valleys on our platform have not secured offtake for more than 25% of the envisaged production volume, whereas, well, a quarter, so 24%, have secured offtake agreements for well above 75% of their production volume. Now, looking at what really makes the difference here, so here we have sort of like sampled them in two groups. So on the left-hand side, you can see the statistics for the valleys with less than 50% secured offtake. And on the right-hand side, you can see the statistics for the valleys with more than 50% offtake secured. First of all, looking at the end-use segments, we can see a sharp trend. So valleys with a large share of secured offtake, they are mostly catering to the industrial use cases, followed by the mobility and then energy use cases. So industry being really a strong end-use segments for valleys with large offtake secured, whereas valleys with less offtake secured, they're really mostly targeting mobility end-use segments. So this leaves some room for interpretation, obviously, but statistics show that the industry use case where we actually already today see a strong demand, not only in the future, are really the anchor for secured offtakes when it comes to our valleys. Then secondly, and that doesn't come at a huge surprise, I think that's a correlation you would expect to see here. Obviously, H2 valleys with a larger share of offtake secured already are much closer to CAD compared to valleys with less offtake secured at this point in time. Now, Marcus, and with that, maybe over to you. That's more like something more tangible for you now, thinking about how to secure offtake.
Yeah, so basically something practical to take away from the last 30 minutes of introductory remarks on the market in general and demand, willingness to pay, etc. So we typically, when we develop an offtake strategy for a project or a portfolio of projects, we go through 4 key steps. One is just first a prioritization of end-use segments in terms of their market potential and relevance. So basically, what are actually especially industrial, but also energy and mobility off-taker segments in the vicinity or in an accessible area of a given project. Then this key question is, do they have, or are they likely to have sufficient willingness to pay given the landed cost that a project can get to, right? As Christian outlined. So are they affected by these very progressive green hydrogen or clean hydrogen regulations in Europe? So this, this concerns also questions of, okay, maybe yes, a European regulation or European directive covers the industry segment that are in, but has that directive really been transposed into national law? Will it take effect? And if it does, what are the penalties, etc., attached to quotas? So how binding, how strong is it really, and what is the expected willingness to pay that you can kind of plan with or calculate with? Yeah. If that's a yes, you continue with a given segment or off-taker. If that's a no, you better look somewhere else. Yeah. And then, then the key question is, okay, how big a demand can you really address? Sort of what's the volumes that are realistic? And that, of course, requires a bit of a sense of, okay, what's the demand the consumption off-takers actually have, especially already today when you're looking to replace gray hydrogen. And then the question sort of how much of that is maybe affected by the regulation, by the quotas, and what are also alternative sourcing options for the off-taker that you're competing against. Yeah, whether that's sort of in-house production, own on-site production, or whether that's competing supply routes from other potential producers and suppliers. And with that shortlist you can produce after steps 1, 2, 3, you can sort of, develop your own hunting scheme and take that list and think of, okay, how to approach off-takers, prospective off-takers, with that pitch of saying, hey, we understand you're going to be affected by regulation X, Y, Z. This concerns likely this much of your volume. We see you have those options, and the options we can offer are the following, and they are actually a very competitive way to supply you with clean hydrogen, green hydrogen in the future. So that's kind of the idea behind this hunting scheme development. And when you get to that point and start having conversation and you feel, hey, there might be a match from a pure economics point of view, then you start to dig deeper, typically into specific offtake questions that are more, let's say, contractual in nature, right? So the actual shaping of agreements that are typically linked then out and required on your end as a producer, as a developer, to the financing of your project, etc. And that's the whole wide world, a set of offtake agreements that Christopher will now lead us into.
Yes, exactly. So in the spirit of keeping things practical, we like to look at what the key success factors are for actually putting together and structuring offtake agreements, and what the key points are that you need to pay attention to in the end make it bankable. And before we start with that, maybe the very fundamental question: why is the specific design and structuring of offtake agreement actually such a big deal in the current market environment? And the answer might seem trivial, but I think it's important to remind ourselves of the key drivers for that at the beginning of this discussion. And there's basically two reasons. Yeah, one is, at the end of the day, if you reach a certain project size and a certain capex and financing need, you move into the space of non-recourse project financing, which is very, very different in nature from corporate financing, due to the fact that it, in essence, means that the banks who lend money to finance the project can only use the cash flows that come directly out of the project to make sure that the debt gets repaid. So they have no recourse on the balance sheet of the sponsors, no matter how big the companies are that are ultimately behind the project. And that means that the cash flows that come out of the project and the revenues that come from offtake, from selling the green hydrogen or the hydrogen-based derivatives that the project produces, are really the make or break factor for making a project bankable. And that basically puts bankable hydrogen offtake agreements front and center when it comes to the discussion of the commercial viability of projects in the current market environment. And this element is made even more prominent due to the fact that, as Marcus has pointed out earlier, we are talking about an early stage market, yeah, where projects are captive in nature. Yeah, so you only build a project if you basically have an off-taker or a set of off-takers lined up, and there's no such configuration where somebody builds a project and then simply sells into a liquid market where they do not know yet who the off-takers will be, because such a liquid market simply does not exist yet. So these two factors combined, the need for having non-recourse or limited recourse project finance, and the fact that we're talking about a relatively early stage, no liquid market, basically makes the structuring of offtake agreements very, very important and indeed the make or break factor for commercial viability of projects overall. So that being said, let's have a look at what an offtake agreement actually is in the overall architecture of a project. Of course, you have many different agreements in place, but it's the key commercial agreement that is concluded between the H2 production asset on the one hand and the H2 end users, where the ultimate application areas sit, and the off-taker, so to speak. And then, of course, you can have various other commercial agreements in between that can be struck between different parties. There's all sorts of configurations conceivable there, transport agreements, storage agreements, combined storage and transport agreements, etc. But at the end of the day, the agreement that unlocks the commercial viability of the case and that also enables the other, let's say, secondary agreements around transport and storage is indeed the offtake agreement. So that's also the starting point of the commercial architecture of the valley or of the project. All right. Of course, an offtake agreement does not fall from the sky. It's a gradual process that basically spans across the entire project development lifecycle, and it's very, very important to also treat it that way and have an ongoing, let's say, work stream dealing with offtake matters from the very initiation of the project all the way to financial close, and in fact also well into the operations phase, because you also need to deal with your off-takers, keep them happy and manage the contracts once the project has reached COD and has become operational and gone on stream. And the typical progression is that you start with the least binding type of agreement, which are letters of intent during the initiation phase, and then you gradually progress those and progress the firmness of the agreements over time as the project progresses overall, moving to heads of terms, where you then have non-binding agreements that already spell out volume and price indications, to term sheets, which tend to be more specific and typically have conditions precedent in place, where you basically say, if the project meets the following milestones and the following things fall into place, then we commit to pay the following price for the following volumes. And then at FID, you need to have a fully termed and binding offtake agreement in place, where those CPs, the conditions precedents, are then lifted so that both equity and debt providers can look at this and say, well, this is a commercial case that is sufficiently firm for me to actually finance this. So that's in an ideal typical sequence how the process should evolve. And what's important to understand is you're basically dealing with three types of players here who have fundamentally different interests that need to be reconciled. On the hydrogen and derivatives project developer side of things, so basically the hydrogen producer, the key priority is, of course, to maximize the return on the hydrogen production asset, and at the very least recover the fixed and the variable cost of the project plus a margin to make the case commercially viable. And ideally, on top of that, typically the asset owners would also like to retain at least some upside potential in case the price of green hydrogen increases in the future. They would like to be able to participate in that. On the off-taker side, you basically have the flip side of this. We talked about a lot of regulation. So for the off-takers, the priority is to actually source the compliance volume, so the volumes that they are obligated to source under the specific regulation that they are subject to at the minimum price possible. So really minimizing their sourcing cost for clean H2, and at the same time they would like to retain the flexibility to benefit from decreasing pricing in the future. And of course, the promise and the talk in the hydrogen industry very much is around a decreasing production costs over the next years because of economies of scale, because of learning rates, etc., etc. So of course, as an off-taker, you don't want to commit to a relatively high price today for the next 10, 15, 20 years when your expectation is that in the marketplace out there, prices might actually decrease. So you want to be able to benefit from that as well. And then you have the lenders, the banks, basically, who ultimately do not care about upsides or downsides because they don't participate in this. For them, the single most important priority is to minimize the likelihood of default so that they get their loan repaid. And in the worst case, that the loan cannot be repaid in full, to minimize the loss should a default occur. So for them, it's all about de-risking the repayment of the loan that they provide. And of course, the art in putting together an offtake assignment is to sort of balance and reconcile those three very opposing views in a way that is acceptable to all three parties. All right. And there's a few topics, let's say, design elements of typical offtake agreements that are very important in all of the offtake discussions and that basically decide whether an offtake agreement becomes viable and bankable or not. And I'll go through them relatively quickly. And what we've done here is we've basically outlined the option space, and then we've highlighted those that are, from a lender perspective, the most desirable ones, where you will not have trouble obtaining financing if you meet those requirements, and then it gets increasingly challenging as you move to the right. When it comes to the contract type, virtually all of the contracts and offtake agreements that we see out there today are take or pay structures, which means that as an offtaker, you commit to paying the price for the volumes that you commit to, regardless of whether you take the product or not. So in worst case, you don't even take the physical delivery, but you would still pay the agreed price for the agreed volumes. So on the revenue side, this is fully de-risked for the project owner and by implication then also for the bank that is financing the project. On the volume side, of course, the biggest preference would be to have a fully fixed offtake commitment, which essentially covers the entire output of the facility of the project. So 100% of the project production volume being covered by an offtake commitment. But of course, there are at the margins certain adjustment clauses for volumes, a bit up, a bit down, that can be baked into such an agreement. But the guiding principle is trying to fix as much volume as possible. On the pricing side, and we'll speak about this in a little bit more detail, the biggest preference is to have fixed pricing that reflects the cost structure of your project. So you know your CapEx. You can ideally also lock in your OpEx to 100% extent. And if that is the case, then you would like to have a fixed pricing in place that ensures that your cost is recovered. What we see, of course, in practice is a lot of hybrid structures where you have elements of fixed pricing and index-based pricing combined. We'll talk about that in a bit more detail later, because they're the devils in the detail in terms of how you design this. Of course, also the credit quality of the offtaker is of utmost importance. The offtaker is the counterparty to the contract, and the higher the credit worthiness, the better from a bankability perspective. And if you can then further underpin and corroborate this with with different types of guarantees, ideally direct sovereign guarantees from a government, then ideally that enhances the bankability and also typically improves the financing conditions in terms of interest rates that a bank imposes. And then a very, very critical topic is the tenor of the offtake. So how long does the contract run for? And there, what banks love is to have an offtake tenor that runs longer than the tenor of the loan. So they basically have full assurance that they can get their loan repaid from the offtake that is covered by the duration of the contract, or at least you need to have a matching of the offtake contract with the duration of the contract of the loan. What they don't like is to run into a situation where the offtake contract is shorter than the loan contract, and then there's, so to speak, a cliff of uncertainty after a number of years where the price that and the volumes, in fact, that the project might be able to sell might actually drop, and that would then affect the debt-bearing capacity of the project. So typically, at least having an offtake contract in place that is at least as long as the loan contract is the make or break factor for getting bankable offtake under a project finance configuration. Of course, everything I've said now is very textbook, very ideal, typical configuration of such a contract. The reality in practice looks a bit different because the bank cares about, as I said, getting their loan repaid. So if you have a portion of your output, a portion of the volumes that your project produces that meets those criteria here, and that is sufficient to pay back the loan, then for the remaining volumes, should there be any remaining volumes, you can venture into, let's say, more risky contract configurations, because then the bank no longer cares because they are covered. Yeah. So in practice, you might have different configurations, different terms with different off-takers. The important thing for the bank is that the overall architecture ensures that they get the loan repaid. Yeah. All right. I spoke about the importance of indexation, and this is a very, very important discussion in many of the offtake agreements that we have worked on. And the reason for that is that indexation in the fossil energy world is very, very typical. Yeah, you say, well, you have a global oil price, you have gas prices at certain trading hubs that are perfectly transparent, etc., etc. And typically, what you do in an offtake contract is that you index, at least to a certain extent. You may have caps and floors, but at least to a certain extent, you index your pricing to whatever happens with these commodities that fluctuate in the market. And that's because this is the reality in the legacy world. That's very often the expectation that off-takers have, especially in industry, when they approach off-take negotiations also for green molecules, so hydrogen and hydrogen-based derivatives. And indexation in principle is possible under contract design and can also be bankable. But it's very, very important that the indexation is only linked to those items in the cost structure of the project that are actually in line with the underlying cost base of the project. Yeah. So, for example, if you have a project where part of the energy that electricity that you source for the electrolyzer comes from the grid, and you have a variable power price in the grid, then of course it makes sense also from the project standpoint to index your price to a certain degree to this fluctuating power price in the market, because it drives the cost structure of your project. If it goes down, your hydrogen becomes cheaper in terms of producing. If it goes up, it becomes more expensive. The same holds for other feedstock prices such as CO2, in case you produce a carbon-containing derivative such as e-methanol or e-SAF. So this is typically also acceptable from a bank standpoint, because you basically take the variable pieces of your cost structure and pass that risk through to the off-taker. What's challenging, and the trouble is that this is what off-takers are typically looking for, is to tie it to things that drive the willingness to pay of off-takers. So very often they look at this and say, well, there's a legacy product, the fossil product, and my willingness to pay is basically the price of the fossil product plus a penalty that I have to pay under regulation. For me, it's rational to pay for the green product if it's below that. If it's higher than that, I might as well buy the fossil product and pay the penalty. Yeah. So they like to index this, for example, then to fossil jet fuel in the case of SAF, to gray ammonia in the case of green ammonia, etc., which of course is not acceptable to the bank, because the bank looks at this and says, wait a minute, the price of gray ammonia out there in the market, or the price of natural gas, does not matter at all for the cost structure of the project that I'm financing. Yeah? Because they don't use natural gas and they don't use gray ammonia. They have a cost structure that comes from the capex that they have deployed, and this needs to be recovered. So this is typically a contentious area when it comes to off-taker negotiations, but this is what banks very much care about. All right. Since we're a bit behind schedule, I'll keep the next section rather brief. What's important is that when putting together your funnel for the hunting scheme, that there's different types of offtake opportunities out there. On the left-hand side, you see the plain vanilla private sector deals. You have an industrial company, you have a transport company. They would like to source green hydrogen or hydrogen-based derivatives. They put out a tender or they do a bilateral negotiation, and that's it, a purely private transaction. On the other side of the spectrum, you have public tenders, where you basically have public authorities or publicly funded bodies that take on the role of being the off-taker or the intermediary, as in the case of H2 Global, and then they run tenders, and then your counterparty basically becomes the government. So there you go through a very transparent, very much standardized tender process, and the approach to how to get into these contracts is fundamentally different from these, let's say, brokered bilateral deals. And then you have something in between, which is private sector deals that are, however, enabled and unlocked by the availability of public funding. So a hybrid model, if you will, where government funding calls provide subsidies to bridge the gap between production cost on the one hand and off-takers' willingness to pay on the other hand. So you still need to find an off-taker in the private marketplace, but you may be able to bridge the gap using public money. So the European Hydrogen Bank is a classic example for that, where you as a producer basically pitch a price. If your price is amongst the lowest, you get the subsidy awarded, but then it's still your problem to find an off-taker and get them to pay an amount where the combination of what they pay and the subsidy you receive is sufficient to sustain your case. So this is a bit blurry in between the two models. And of course, all three types should play a role when you put together your off-taker funnel, because all of those are opportunities that might be relevant for you. Moving on, what's then important is that along the project lifecycle, you basically start with the market screening and putting all of these opportunities that I have just outlined into the funnel in the very beginning. And then you narrow this down over time, moving, as I have explained before, from LOIs, ideally all the way to fully termed and fully binding hydrogen offtake agreements. And what's important is the third element that you see at the bottom, that basically runs across the entire process chain, which is the bankability check. So what you need to do is you basically need to build in a constant feedback loop with your potential lenders, where you keep them posted about the ongoing negotiations, and you bounce the terms that you are negotiating with potential off-takers off of the bank to check if those would actually be acceptable. And then it has to be basically an iterative process where you speak with the off-takers, you speak with the bank, you try to broker between the two, etc., and ultimately try to put together terms that are acceptable to both parties, or to all three parties, I should rather say. So that's the important thing here. Last point I want to make is it's very, very important to have this offtake topic as a constant and ongoing work stream across the entire project lifecycle, which should start very early in the project. And the second element is it's very, very important to make sure that this is not done in isolation, because there are very strong interdependencies and linkages between other work streams, in particular in the earlier stages when you are still shaping up also the technical design, the sizing, and the concept of the project overall. For example, off-taker requirements in terms of flows, in terms of when they need certain volumes, in terms of seasonality, etc., might actually impact the technical design of your project, the asset sizing, the extent to which you need storage, etc., etc. So it should be a constant back and forth between what you learn from the off-taker discussions and how you then tailor your project accordingly to meet the off-taker requirements. So don't treat it as a silo, but make sure that it's properly connected with the other work streams that are more technical in nature. And the last point is, we tend to see a lot of projects which take the technical dimension as the leading and dominant dimension, and they design the stage gates accordingly. And this is normal. You have a pre-feasibility study, a feasibility study, the FEED, etc. and those are the milestones against which the project is managed. However, all of these stage gates should not only have a technical dimension, but they should also have an offtake dimension. Because even if you have a perfect FEED in place, if at that point in time, as we have indicated here, you don't have at least for 80% of the volumes a binding timesheet in place, you will run into trouble, and then you have a perfect project from a technical optimization standpoint, but very limited commercial viability. So really linking these stage gates and making sure that they have both the technical dimension and the offtake dimension covered, in our experience, is what's sometimes lacking in practice and what is really critical to make things fly. Maybe just one last thing that I would like to repeat, as I have pointed out in the beginning, there will be other webinars coming up, the next one in December, the one thereafter in November, that have already been scheduled. So it would be great to see all of you there as well and continue the exchange. Again, as I've mentioned several times throughout the presentation, would be great if you could check out h2b.eu as the facility's overall landing page and single point of contact. And what you find in there specifically are those self-service materials that I have mentioned before, which do provide the type of guidance and the type of insights that we have now shared in the webinar across a wide range of different topics: commercial, technical, regulatory, governance, and organization. So hopefully you can find something that is of help to you for where your respective values and projects stand at this point in time. So it would be great if you could check that out. And last but not least, if there's any questions, any follow-ups, by all means, use the contact opportunity on the website, and we'll happily get back to you. All right. I believe that would be it from our side. Any closing words, Antonio, Mirela, from your end?
I mean, just to thank everyone that attended, and I think in one way or the other, it would be good to have now or after the second workshop some feedback from you, because we are planning to run these webinars throughout the duration of the facility, which still has 4 years. So yeah, any feedback, let us know, of course, and thank you for joining.
Same on my side, likewise. Thank you very much for being with us. I have to say, I'm impressed by the number of the attendees, and thank you very much also to the colleagues in Roland Berger for the very insightful webinar. Thank you very much.
Absolutely. Thank you.
Thank you, and have a good rest of the week, and hopefully see all of you soon.